Basic concepts and calculations. Economics is not an exact science. It consists merely of laws of probability. The most prudent investor, therefore, is one who pursues only a general course of action which is normally right, and who avoids acts and policies which are normally wrong. With the computer software and the trading platforms making price analysis easier and more sophisticated, we no longer think of the steps involved in a moving average or linear regression. A few years ago, we looked at the correlation between investments only when absolutely necessary because they were too complicated and time consuming to calculate. It would even be difficult to know if you had made a mistake without having someone else repeat the same calculations. Now we face a different problem. If the computer does it all, we lose our understanding of why a moving average trend line differs from a linear regression. Without looking at the data, we don't see an erroneous outliner or that the stock wasn't adjusted for splits. By not reviewing each hypothetical trade, we miss seeing that the slippage can turn a profit into a loss. To avoid losing the edge needed to create a profitable trading strategy, the basic tools of the trade are explained in this chapter. Those of you already familiar with these methods may skip over it. Others need to be confident that they can perform these calculations manually even while they use a spreadsheet. Helpful software. In Excel, many of the functions, such as the standard deviation, are readily accessible at any time. The more advanced statistical functions require that you install the add-ins, which also come free with Excel. These include histograms, regression analysis, f-test, t-test, z-test, Fourier analysis, and various smoothing techniques. To install these add-ins in Excel 2010, go to File Options, Add-ins, and select the Analysis Tool Pack. You will also want the Solver add-in. Once installed, which takes only a few seconds, these functions can be accessed in the Data menu at the top of the screen. You should find the Data Analysis and Solver options at the far right on the menu bar. There are other very useful and user-friendly statistical programs available at a wide range of sophistication and price. One of the best values is ProStat by Polysoftware, polysoftware.com. The examples in this chapter will use both Excel and ProStat. About data and averaging, the law of averages. We begin at the beginning with the law of averages is a greatly misunderstood and misquoted principle. In trading, the law of averages is most often referred to when an abnormally long series of losses is expected to be offset by an equal and opposite run of profits. It is equally wrong to expect a market that is currently overvalued or overbought to next become undervalued or oversold. That is not what is meant by the law of averages. Over a large sample, the bulk of events will be scattered close to the average in such a way that the typical values overwhelm the abnormal events and cause them to be insignificant. This principle is illustrated in Figure 2.1, where the number of average items is extremely large and the addition of a small abnormal grouping to one side of an average group of near normal data does not affect the balance. It is the same as being the only passenger on a jumbo jet. Your weight is insignificant to the operation of the airplane and not noticed when you move about the cabin. A long run of profits, losses, or an unusually sustained price movement is simply a rare, abnormal event that will be offset over time by the overwhelming large number of normal events. Further discussion of this and how it affects trading can be found in Gambling Techniques, The Theory of Runs, Chapter 22. In sample and out-of-sample data, proper test procedures called for separating data into in-sample and out-of-sample sets. This will be discussed in Chapter 21, System Testing. For now, consider the most important points. All testing is overfitting the data, yet there is no way to find out if an idea or system works without testing it. By setting aside data that you have not seen to use for validation, you have a better chance that your idea will work before putting money on it. There are many ways to select in-sample data. For example, if you have a 20 years of price history, you might choose to use the first 10 years for testing and reserve the second 10 years for validation. But the markets change over time. They become more volatile and may be more or less trending. It might be best to use alternating periods of in-sample and out-of-sample data in 2-year intervals, provided that you never look at the data during the out-of-sample periods. Alternating these periods may create a problem for continuous long-term trends, but that will be resolved in Chapter 12. In Chapter 21, the most important factor when reserving out-of-sample data is that you get only one chance to use it. Once you have done your best to create the rules for a trading program, you then run that program through the unseen data. If the results are successful, then you can trade the system, but if it fails, then you are also done. You cannot look at the reasons why it failed and change the trading period to perform better. You would have introduced the feedback and your out-of-sample data is considered contaminated. The second try will always be better, but it is now overfitted. How much data is enough? Statisticians will say more is better. The more data you test, the more reliable your results. Technical analysis is fortunate to be based on a perfect set of data. Each price that is recorded by the exchange, whether it's IBM at the close of trading in New York on May 5th, or the price of euro-dollar interest rates at 10.05 in Chicago, it's confirmed precise value. Remember that when you use in-sample and out-of-sample data for development, you need more data. You will only get half the combinations and patterns when 50% of the data has been withheld. Economic data. More other statistical data are not as timely, not as precise, and not as reliable as the price and volume of stocks, futures, ETFs, and other exchange-traded products. Economic data such as the Producer Price Index or housing starts are released as monthly averages and can be seasonally adjusted. A monthly average represents a broad range of numbers. In the case of the PPI, some producers may have paid less than the average of the prior month and some more, but the average was plus 0.02. The lack of a range of values or a standard deviation of the component values reduces the usefulness of the information. Thus, statistical data is often revised in the following month. Sometimes those revisions can be quite large. When working with the Department of Energy DOE weekly data releases, you will need to know the history of the exact numbers released as well as the revisions if you are going to design a trading method that reacts to those reports. You may find that it is much easier to find the revised data, which is not what you really need. If you use economic data, you must be aware of when that data is released. The United States is very precise and prompt, but other countries can be monthly or yearly late in releasing data. If the input to your program is monthly data and comes from the CRB yearbook, be sure that you check when that data was actually available. Sample error. When an average is used, it is necessary to have enough data to make that average accurate. Because much statistical data is gathered by sampling, particular care is given to accumulating a sufficient amount of representative data. This holds true with prices as well. Averaging a few prices or analyzing small market moves will show more erratic results. It is difficult to draw an accurate picture from a very small sample. When using small, incomplete, or representative sets of data, the approximate error or accuracy of the sample can be found using the standard deviation. A large standard deviation indicates an extremely scattered set of points, which in turn makes the average less representative of the data. This process is called the testing of significance. Accuracy increases as the number of items becomes larger, and the measurement of the sample error becomes proportionally smaller. So the formula is as follows. The sample error is equals to 1 divided by the square root of number of items sampled, which is equals to 1 divided by the square root of n, or 1 divided by SQRT of n. Therefore, using only one item has a sample error of 100%. With four items, the error is 50%. The size of the error is important to the reliability of any trading system. If a system has had only 4 trades, whether profits or losses, it is very difficult to draw any reliable conclusions about future performance. There must be sufficient trades to assure a comfortably small error factor. To reduce the error to 5%, there must be 400 trades. This presents a dilemma for a very slow trend following method that may only generate 2 or 3 trades each year. To compensate for this, the identical method can be applied across many markets and the number of trades used collectively. More about this in chapter 21. 21st, sorry. Representative data. The amount of data is a good estimate of its usefulness. However, the data should represent at least one bull market, one bear market, and some sideways periods. More than one of each is even better. If you were to use 10 years of daily S&P index values from 1990 to 2000 or 25 years of 10-year Treasury notes through 2010, you would only see a bull market. A trading strategy would be profitable whenever it was a buyer if you held the position long enough. Unless you included a variety of other price patterns, you would not be able to create a strategy that would survive a downturn in the market. The results would be unrealistic. Data that is no longer useful. There are clear cases when a stock or futures market has undergone a structural change and the current data is different from historic data. The evolution of General Electronic (GE) from a manufacturer of light bulbs to a massive financial institution represents a structural change. Its transformation back to a manufacturing company announced in 2010 may be another structural change. A company that began in the United States, such as McDonald's, but expanded to have large international exposure, also shows a structural change in its price patterns. In a foreign exchange, we have seen the individual European currencies first tied together by agreement, then finally merged into a single unit, the euro. Is it important to include historical data in your testing when the data represents a different company profile or a different geopolitical situation? Ideally, your strategy is robust if it can adapt to these changing profiles and show consistently profitable returns over a long test period. The statisticians have that point in their favor. Longer really is better. These companies and markets will continue to evolve, and your program will need to continue to adapt. As a very fast trader, you may think about limiting your testing to much shorter periods. If you trade once each day, then in 5 years you would generate 1,250 trades. In 10 years, 2,500 trades. If your trading strategy is profitable over 2,500 trades, then you've satisfied the issue of the sampling error. However, you may not have included data that is representative of the different types of markets and a variety of price patterns. Even with a large number of trades, tests spanning many years will be needed to show robustness. Safety first. It is important to remember that the accuracy of your testing depends on both the amount of data used and the number of trades generated by the system. If your estimates of loss are not reliable, you put your investment at risk. On average, in working with numbers, it is often necessary to use representative values. The range of values or the average may be substituted to change a single price into a general characteristic in order to solve a problem. The average arithmetic mean of many values can be a preferable substitute for any one value. For example, the average retail price of 1 pound of coffee in the Northeast is more meaningful to a cost of living calculation than the price at any one store. However, not all data can be combined or averaged and still have meaning. The average of all prices taken on the same day would not say anything about an individual market that was part of the average. Averaging the prices of unrelated items, such as a box of breakfast cereal, the hourly cost of automobile repair, and the price of the German DAX index, would produce a number of questionable value. The average of a group of numbers must have some useful meaning. The average can be misleading in other ways. Consider coffee, which rose from $0.40 to $2 per pound in 1 year. The average price of this product may appear to be $1.2. However, this would not account for the time that coffee was sold at various price levels. Table 2.1 divides the coffee price into 4 equal intervals, then shows that the time spent at these intervals was uniformly opposite to the price rise. That is, prices remained at lower levels longer and at higher levels for shorter time periods, which is very normal price behavior. When the time spent at each price level is included, it can be seen that the average price should be lower than $1.2. One way to calculate this, knowing the specific number of days in each interval, is by using a weighted average of the price. That is, W equals to A1 times D1 plus A2 times D2 plus A3 times D3 plus A4 times D4 divided by D1 plus D2 plus D3 plus D4. And its respective interval is equals to W equals to 6,000 plus 8,000 plus 8,400 plus 7,200 divided by 280. So W is equals to 105.71. The results can vary based on the number of time intervals used. However, it gives a better idea of the correct average value, average price. There are 2 other averages for which time is an important element, the geometric mean and the harmonic mean. Geometric mean. The geometric mean represents a growth function in which a price change from 50 to 100 is as important as a change from 100 to 200. If there are n prices, A1, A2, A3 until AN, then the geometric mean is the nth root of the product of the prices. That is that G equals to A1 times A2 times A3 and so on times AN. Then after that we take the nth root of it. Or using the script, the instruction product of A1, A2, A3 and so on until AN to the 1 over n To solve this mathematically, rather than using a spreadsheet, the equation above can be changed to either of the two forms. Ln of g equals to ln of a1 plus ln of a2 plus ln of a3 and so on plus ln of an, then divided by n. Or ln of g is equals to ln of a1 times a2 times a3 and so on times an, then divided by n. The two solutions are equivalent. The term ln is the natural log or log base e. Note that there is some software where the function log actually is ln. Using the price levels in a table 2.1, that is ln of g is equals to ln of 40 plus ln of 80 plus ln of 120 plus ln of 160 plus ln of 200 divided by 5. Disregarding the time intervals and substituting into the first equation, ln of g is equals to 3.689 plus 4.382 plus 4.787 plus 5.075 plus 5.298 divided by 5. Then ln of g is equals to 4.6462. G is equals to 104.19. While the arithmetic mean, which is time weighted, gives a value of 105.71, the geometric mean shows the average as 104.19. It's a smaller.
The geometric mean has advantages and applications to economics and application.
The classic example compares a tenfold rise
classic example
price
compares
from 100 to 1000
rise
to a fall to 1/10 from 100 to 10
to a fall
and
to
arithmetic mean
1/10
of
from
two values 10
100
and
to
1000 is 505.
and arithmetic mean
While
of
the
two
geometric
values
mean gives
10
g equals
and
to
1000
10
is
times
505.
1005. Then take the
While
square
the geometric
root,
mean
which is
gives
equals to 100.
g equals to
And it shows
10
the
times
relative
1000,
distribution
then to the
of
square root,
prices
which is
as a
equals
function
to
of a comparable growth.
100.
Due to
And
this
shows
property,
the relative
the geometric mean
distribution
is the
of
best
prices
choice
as a function
when
of
averaging
comparable growth.
ratios that
Due to
can
this
be
property,
either
the
fractions
geometric mean
or
is the best
percentages.
choice when averaging ratios that can be either
Quadratic
fractions
mean.
or
The quadratic mean
percentages.
is most often used
Quadratic
for
mean.
estimation of
The
error.
quadratic mean
It
is calculated
most often
as
used
Q
for
equals to the
estimation
square
of
root
error.
of. It
The
is
summations of a
calculated
squared
as
then
Q
divided by
equals
n.
to the square
The
root
quadratic
of
mean is
the
the
summations
square
of
root
a
of the
squared
mean of the
then
square
divided
of the
by n.
items.
The quadratic mean is the square
It is
root of
most
the mean
well
of the
known
square
as
of
the
the
basis
items.
for the
Root
standard
mean
deviation.
square. It is
This will be
most
discussed
well known
later in this
as
chapter
the basis for
in the
the
section
standard deviation.
Moments
This will
of
be
the
discussed
distribution.
later in this chapter
Variance,
in the section
skewness,
Moments
and
of the
kurtosis.
distribution.
Harmonic
Variance,
mean. The
skewness,
harmonic mean is
and
another
kurtosis.
time-weighted average,
Harmonic
but not
mean.
biased
The
toward
harmonic
higher or
mean
lower
is
values.
another time-weighted
As in the
average,
geometric mean.
but not
A
biased
simple
toward
example
higher
is to consider
or
the
low
average
values as in the
speed of a
geometric
car
mean.
that
A
travels 4
simple
miles
example
at
is to
20
consider
mph.
the average
Then
speed
4
of
miles
a
at
car
30 mph.
that travels 4
And
miles
arithmetic
at
mean
to
would give
20 mph.
25 mph.
Then 4 miles
Without
at
considering
30
that 12
mph.
minutes were
And
spent at 20
arithmetic
mph
mean would
and
give
8 minutes at 30
25
mph.
mph.
The weighted average
Without
would give
considering
to be
that
equals to
12 minutes
times
were
20
spent at
plus
20
8 times
mph
30, then
and
divided
8
by the
minutes
summations of
at
12
30
plus
mph.
8, which is equals to
The
24.
weighted average
The
would
harmonic
give
mean is
to
1
be
over
equals
h
to
is equals to
12
1
times
over a1
20
plus 1
plus
over a2
8
plus 1
times
over a3
30,
and so on plus
then
1 over
divided by
an.
12 plus 8,
Then
which
after
is
the
equals to
summation, we
24.
divided by n,
The
which can
harmonic
also be
mean
expressed
is 1
as
over h is
h
equals to
n
1
divided
over
by
a1
the summations
plus
of 1 over
ai
a2, summing
plus
with index
1
I
over
starting from
a3
1
and
to
so on
n.
plus 1 over
For 2
an.
or 3
Then
values,
after the
the
summation,
simple form
we
can be
divided by
used.
n,
h2 equals to
which
2ab
can also be
divided by a
expressed
plus b,
as
and
h
h3 equals to 3
equals
abc
to
divided
n
by
divided
ab
by
plus ac
the
plus
summations of
bc.
1 over ai, where the summation
This
is starting
allows
for
the
index
solution
I
pattern
starting
to
from
be
1
seen.
to n.
For the 20
For
and
2
30
or
mph
3
rates
values,
of speed,
the simpler
solution
forms
is
can be
h2
used
equals
that
to
h2
2
is
times
equals
20
to
times
2ab
30
divided by a plus
divided by
b,
20
and
plus
h3
30,
is equals
which is
to
equals to
3abc divided by
which
ab
is
plus
the
ac
same
plus
answer
bc.
as the weighted
This
average.
allows the solution patterns to be
So
seen.
considering the
For the
original
20 and
set
30
of
mph
numbers
rates
again,
of speed, the
the
solution
basic form
is
of a harmonic mean can be applied. 1 over h is equals to 1 over 40 plus 1 over 80 plus 1 over 120 plus 1 over 160 plus 1 over 200. Then after the summation, we divide it by 5. Solve this formula, we get the solution h equals to 87.59, which is equals to 0.5708 divided by 5, which is equals to 0.01142. We might apply the harmonic mean to price swings, where the first swing moved 20 points over 12 days and the second swing moved 30 points over 8 days. Price distribution. The measurement of distribution is very important because it tells you generally what to expect. We cannot know what tomorrow's S&P trading range will be, but if the current price is 1,200, then we have a high level of confidence that it will fall between 900 and 1,500 this year, but less confidence that it will fall between 1,100 and 1,300. We have much less confidence that it will fall between 1,150 and 1,250, and we have virtually no chance of picking the exact range. The following measurements of distribution allow you to put a probability or a confidence level on the chance of an event occurring. In all of the statistics that follow, we will use a limited number of prices or, in some cases, individual trading profits and losses as the sample data. We want to measure the characteristics of our sample, finding the shape of the distribution, deciding how results of a smaller sample compare to a larger one, or how similar two samples are to each other. All of these measures will show that the smaller samples are less reliable, yet they can still be used. If you understand the size of the error or the difference in the shape of the distribution compared to the expected distribution of a larger sample. Frequency distributions. The frequency distribution, also called a histogram, is simple yet can give a good picture of the characteristics of the data. Theoretically, we expect the commodity prices to spend more time at low price levels and only brief periods at high prices. That pattern is shown in figure 2.2 for wheat during the past 25 years. The most frequent occurrences are at the price where the supply and the demand are balanced, called equilibrium. When there is a shortage of supply or an unexpected demand, prices rise for a short time until either the demand is satisfied, which could happen if prices are too high, or supply increases to meet demand. There is usually a small tail to the left where prices occasionally trade for less than the cost of production or at a discounted rate during periods of high supply. To calculate a frequency distribution with the 20 bins, we find the highest and lowest prices to be charted and divide the difference by 19 to get the size of one bin, beginning with the lowest price, add the bin size to get the second value, add the bin size to the second value to get the third value, and so on. When completed, you will have 20 bins that begin at the lowest price and end at the highest price. You then can count the number of prices that fall into each bin, a nearly impossible task, or you can use a spreadsheet to do it. In Excel, you go to data/data analysis/histogram and enter the range of bins which you need to set up in advance and the data to be analyzed. Then select a blank place on the spreadsheet for the output results. To the right of the bins is good and click OK. The frequency distribution will be shown instantly. You can then plot the results seen in figure 2.3. The frequency distribution shows that the most common price fell between $3.5 and $4 per bushel, but the most active range was from $2.5 to $5. The tail to the right extends to just under $10 per bushel and clearly demonstrates the fat tail in the price distribution. If this was a normal distribution, there would be no entries past $6. The absence of price data below to $25 is due to the cost of production. Below that price, farmers would refuse to sell at a loss. However, the US government has a price support program that guarantees a minimum return for farmers. The wheat frequency distribution can also be viewed net of inflation or changes in the US dollar. This will be seen at the end of this chapter. Short-term distributions. The same frequency distributions occur even when we look at shorter time intervals, although the pattern is more erratic as the time interval gets very small. If we take wheat prices for the calendar year 2007, in the figure 2.4, we see a steady move up during mid-year, followed by a wider ranging sideways patterns at higher level. However, the frequency distribution in figure 2.5 shows a pattern similar to the long-term distribution, with the most common value at a low level and a fat tail to the right. If we had picked the few months just before prices peaked in September 2007, the chart might have shown the peak price further to the right and the fat tail on the left. For commodities, this represents a period of price instability and expectations that prices will fall. It should be expected that the distribution of prices for a physical commodity, such as agricultural products, metals, and energy, will be skewed toward the left, more occurrences at lower prices, and have a long tail at higher prices toward the right of the chart. This is because prices remain at relatively higher levels for only short periods of time, while there is an imbalance in supply and demand. In the stock market, history has shown that stocks will not sustain exceptionally high price or earnings P/E ratios indefinitely. However, the period of adjustment can be drawn out over many years, unlike an agricultural product that begins again each year. When observing shorter price periods, patterns that do not fit the standard distribution may be considered in a transition. Readers who would like to pursue this topic should read Chapter 18, especially the sections Distribution of Prices and Steinmeier's Market Profile. The measures of a central tendency discussed in the previous section are used to describe the shape and extremes of price movement shown in the frequency distribution. The general relationship between the three principal means when the distribution is not perfectly symmetric is arithmetic mean is greater than geometric mean is greater than harmonic mean. Median and mode. Two other measurements, the median and the mode, are often used to define the distribution. The median, or middle item, is helpful for establishing the center of the data. When the data is sorted, it is the value in the middle. The median has the advantage of discounting extreme values, which might distort the arithmetic mean. Its disadvantage is that you must sort all of the data in order to locate the middle point. The median is preferred over the mean except when using a very small number of items. The mode is the most commonly occurring value. In figure 2.5, the mode is the highest bar in the frequency distribution at pin 800. In a normally distributed price series, the mode, mean, and median all occur at the same value. However, as the data becomes skewed, these values will move further apart. The general relationship is mean is greater than median is greater than mode. A normal distribution is commonly called a bell curve, and values fall equally on both sides of the mean. For much of the work done with price and performance data, the distribution tends to be skewed to the right, toward higher prices or higher trading profits, and appear to flatten or cut off on the left, lower prices or trading losses. If you were to chart a distribution of trading profits and losses based on a trend system with a fixed stop loss, you would get profits that could range from 0 to very large values, while the losses would be theoretically limited to the size of the stop loss. Skewed distributions will be important when we measure probabilities later in this chapter. There are no normal distributions in a trading environment. Characteristics of the principal averages. Each average method has its unique meaning and usefulness. The following summary points out their principal characteristics. The arithmetic mean is affected by each data element equally, but it has a tendency to emphasize extreme values more than other methods. It is easily calculated and is subject to algebraic manipulation. The geometric mean gives less weight to extreme variations than the arithmetic mean and is most important when using data representing ratios or rates of change. It cannot be used for negative numbers but is also subject to algebraic manipulation. The harmonic mean is most applicable to time changes and, along with the geometric mean, has been used in economics for price analysis. It is more difficult to calculate. Therefore, it is less popular than either of the other averages, although it is also capable of algebraic manipulation. The mode is the most common value and is only determined by frequency distribution. It is the location of greatest concentration and indicates a typical value for a reasonably large sample. With an unsorted set of data, such as prices, the mode is time-consuming to locate and is not capable of algebraic manipulation. The median is the middle value and is most useful when the center of an incomplete set is needed. It is not affected by extreme variations and is simple to find. However, it requires sorting the data, which causes the calculations to be slow. Although it has some arithmetic properties, it is not readily adaptable to computational methods. Moments of the distribution, variance, skewness, and kurtosis. The moments of the distribution describe the shape of the data points, which is the way they cluster around the mean. There are 4 moments: mean, variance, skew, and kurtosis, each describing a different aspect of the shape of the distribution. Simply put, the mean is the center of average value. The variance is the distance of the individual points from the mean. The skew is the way the distribution leans to the left or right relative to the mean, and the kurtosis is the peakedness of the clustering. We have already discussed the mean, so we will start with the second moment. In the following calculations, we will use the bar notation P bar to indicate the average of a list of n prices. The capital P refers to all prices and the small p to individual prices. P bar is equal to the summations of pi summing with index I starting from 1 to n. Then after the summation, it was divided by n. The mean deviation, MD, is a basic method for measuring distribution and may be calculated about any measure of a central location, such as the arithmetic mean. MD is equal to the summations of the absolute values of pi minus p bar summing with index I starting from 1 to n, then divided by n. The mean deviation is the average of the differences between each price and the arithmetic mean of those prices, or some other measure of central location with all differences treated as positive numbers. This formula will be seen often throughout the book. Variance, second moment. Variance, VAR, which is very similar to mean deviation, the best estimation of dispersion, will be used as the basis for many other calculations. It is variance is equal to the summations of pi minus p bar to the square, summing with index I starting from 1 to n, then divided by n minus 1. Notice that the variance is the square of the standard deviation. That is, variance is equal to S squares. One of the most commonly used statistics. In Excel, the variance is the function var of list, and in TradeStation's easy language, it is variance of a series n. The first parameter is series, the second parameter is n. Now, the standard deviation S, most often shown as sigma, is a special form of measuring average deviation from the mean, which uses the root mean square. That is, sigma equals to the square root of the summations of pi minus p bar to the square, summing with index I starting from 1 to n, then divided by n. After we divide by n, we take the square root, then we get the sigma. Where the differences between the individual prices and the mean are squared to emphasize the significance of extreme values, and then the total value is scaled back using the square root function. This popular measure used throughout this book is the Excel function stdevp and the TradeStation function stddev of price n for n prices. The standard deviation is the most popular way of measuring the dispersion of data. The value of one standard deviation about the mean represents a clustering of about 68% of the data, two standard deviations from the mean including 95.5% of all data, and three standard deviations encompass 99.7%, nearly all the data. While it is not possible to guarantee that all data will be included, you can use 3.5 standard deviation to include 100% of the data in a normal distribution. These values represented the groupings of a perfectly normal set of data, showing figure 2.6. Skewness is third moment. Most priced data, however, are not normally distributed for physical commodities such as gold, grains, energy, and even interest rates. Expressed at yields, prices tend to spend more time at low levels and much less time at extreme highs. While gold peaked at $800 per ounce for one day in January 1980, it remained between $250 and $400 per ounce for most of the next 20 years. If we had taken the average at $325, then it would be impossible for the price distribution to be symmetric. If one standard deviation is $140, then a normal distribution would show a high likelihood of prices dropping to $185, an unlikely scenario. This asymmetry is most obviously in agricultural markets, where a shortage of soybeans or coffee in one year will drive prices much higher, but a normal crop the following year will return those prices to previous levels. The relationship of price versus time, where markets spend more time at lower levels, can be measured as skewness, the amount of distribution, a distortion from a symmetric distribution, which makes the curve appear to be short on the left and extended to the right. Higher prices. The extended side is called the tail, and a longer tail to the right is called the positive skewness. Negative skewness has the tail extending toward the left. This can be seen in figure 2.7. In a perfectly normal distribution, the mean, the median, and the mode all coincide. As prices become positively skewed, typical of a period of high prices, the mean will show the greatest change, the mode will show the least, and the median will fall in between. The difference between the mean and the mode adjusted for dispersion using the standard deviation of the distribution gives a good measure of skewness. That is, the skewness of the sequence Sk is equals to mean divided minus mode, then divided by standard deviation. That's skewness. The distance between the mean and the mode in a moderately skewed distribution turns out to be 3 times the difference between the mean and the median. The relationship can also be written as skewness of the sequence Sk is equals to 3 times mean minus median then divided by the standard deviation. To show the similarity between the second and the third moments, variance, and skewness, the more common computational formula is Sk is equals to the summation of pi minus p bar to the cube. Then we summing for all index I starting from 1 to n. Then we divide it by n minus 1 times sigma to the cube, where n is the number of prices in the distribution, and the sigma is the standard deviation of the prices. The functions for skew can be found in Excel and the TradeStation. Transformations. The skewness of data series can sometimes be corrected using a transformation. Price data may be skewed in a specific pattern. For example, if there are 3 occurrences at twice the price and 1 divided by 9 of the occurrences at 3 times the price, the original data can be transformed into a normal distribution by taking the square root of each data item. The characteristics of price data often show a logarithmic power or square root relationship. To calculate the probability level of a distribution based on the skewed distribution of price, we can convert the normal probability to the exponential probability equivalent PE using PE equals to x bar times log base 10 of 1 divided by 1 minus 10. Then after that, we divide it by log base 10 to the e, where x bar is the average of all prices and p is equals to normal probability, and log base 10 to the value of e is equals to .434294482, while the normal probability b understates the probability of occurrence in a price distribution. The exponential distribution PE will overstate the probability. Whenever possible, it is better to use the exact calculation. However, when calculating risk, it must be best to err on the side of slightly higher than expected risk. Skewness in distributions at different relative price levels. Because the power price levels of most commodities are determined by production costs, price distributions show a clear tendency to resist moving below these thresholds. This contributes to the positive skewness in those markets, considering only the short term. Then, when prices are at unusually high levels, they can be volatile and unstable, causing a negative skewness that can be interpreted as being top-heavy. Somewhere between the very high and the very low price levels, we may find a frequency distribution that looks normal. Figure 2.8 shows the change in the distribution of prices over, for example, 20 days as prices move sharply higher. The mean shows the center of the distributions as they change from positive to negative skewness. This pattern indicates that a normal distribution is not appropriate for all price analysis, and that a log exponential or power distribution would only apply best to long-term analysis. Kurtosis' fourth moment. One last measurement, kurtosis, is needed to describe the shape of a price distribution. Kurtosis is the peakedness or flatness of a distribution as shown in figure 2.9. This measurement is good for an unbiased assessment of whether prices are trending or moving sideways. If you see prices moving steadily higher, then the distribution will be flatter and cover a wider range. This is called negative kurtosis. If prices are range-bound, then the frequency will show clustering around the mean, and we have positive kurtosis. Steelmayer's market profile, discussed in chapter 18, uses the concept of kurtosis with the frequency distribution accumulated dynamically using real-time price changes. Following the same form as the third moment, skewness, kurtosis can be calculated as k equals to the summations of pi minus p bar, then to the fourth, where the summation is summing for all index I starting from 1 to n, then divided by n minus 1 times sigma to the fourth. As an alternative calculation for kurtosis is k equals to n times n plus 1 divided by n minus 1 times n minus 2 times n minus 3, then times the summations of pi minus p bar, then divided by sigma. After divided by the sigma, then we take to the fourth. Then after we take the summation, we minus a term. That is, we minus 3 times n minus 1 to the square, then divided by n minus 2 times n minus 3, where n is the number of prices in the distribution, and pi is the individual prices, and p bar is the average of n prices, and the sigma is the standard deviation of prices. Most often, the exact kurtosis is used, which makes it easier to see abnormal distributions. Exact kurtosis ke is equals to k minus 3, because the normal value of the kurtosis is 3. Kurtosis is also useful when reviewing system tests. If you find the kurtosis of the daily returns, they should be somewhat better than normal if the system is profitable. However, if the kurtosis is above 7 or 8, then it begins to look as though the trading method is overfitted. A high kurtosis means that there are an overwhelming number of profitable trades of a similar size, which is not likely to happen in real trading. Any high value of kurtosis should make you immediately suspicious. Choosing between a frequency distribution and standard deviation. Frequency distributions are important because the standard deviation doesn't work for skewed distributions, which is most often for most price data. For example, if we look back at the histogram for wheat, the average price over the past 25 years was $3.62, and the standard deviation of those prices was $1.16. Then one standard deviation to the left of the mean is $2.46, a bin which has no data. On the right side, 3.5 standard deviation, which should contain 100% of the data, which is $7.68, far below the actual high price. Then using the standard deviation can fail on both ends of the distribution for highly skewed data, while the frequency distribution gives a very clear and useful picture. If we wanted to know the price at the 10% and 90% probability levels based on the frequency distribution, we would sort all the data from low to high. If there were 300 monthly data points, then the 10% level would be in position 30 and the 90% level in the position 271. The median price would be at position 151. This is shown in figure 2.10. When there is a long tail to the right, both the frequency distribution and the standard deviation implies that large moves are to be expected. When the distribution is very symmetric, then we are not concerned. For those markets that have had extreme moves, neither method will tell you the size of the extreme move that could occur. There is no doubt that given enough time, we will see profits and losses that are regular than we have seen in the past, perhaps much larger. Autocorrelation. Serial correlation and or autocorrelation means that there is a persistence in the data. That is, future data can be predicted to some degree from past data. Such a quality could indicate the existence of trends A. A simple way of finding autocorrelation is to put the data into column A of a spreadsheet, then copy it to column B while shifting the data down by one row, then find the correlation of column A and column B. Additional correlations can be calculated shifting column B down 2, 3, or 4 rows, which might show the existence of a cycle. A formal way of finding autocorrelation is by using the Durbin-Watson test, which gives the D statistic. This approach measures the change in the errors E the difference between n data points and their average value, that is ei equals to ri minus the summations of ri summing with I starting from n plus 1 until I equals to t. T is equals to the summations of ei minus 1, then to the square, then summing for I starting from t minus n plus 1 until t. And divided by the summations of ei squared, summing from index starting from t minus n plus 1 until t. So the previous ei is also summing for all ri summing from index I minus n to plus 1 until t, then divided by n. The value of d always falls between 0 and 4. There is no autocorrelation if d is equal to 2. If d is substantially less than 2, there is positive autocorrelation. However, if it is below 1, then there is more similarity in the errors than is reasonable. The farther d is above 2, and the more negative autocorrelation appears in the error terms. A positive autocorrelation or serial correlation means that a positive error factor has a good chance of following another positive error factor. Probability of achieving a return. To be uncertain is to be uncomfortable, but to be certain is to be ridiculous. Chinese proverb. If we see the normal distribution, figure 2.6, as the annual returns for the stock market over the past 50 years, then the mean is about 8%, and one standard deviation is 16%. In any 1 year, we can expect the returns to be 8%. However, there is a 32% chance that it will be either greater than 24%, the mean plus one standard deviation, or less than minus 8%, the mean minus one standard deviation. If you would like to know the probability of a return of 20% or greater, you must first rescale the values. That is, the probability of reaching objective is equals to objective minus mean, then divided by standard deviation. If your objective is 20%, we calculate the probability is equals to 20% minus 8%, then divided by 10%, which is equals to 0.75. Table 1.1 Appendix 1 gives the probability for normal curves. Looking up the standard deviation of 0.75 gives 27.34%, a grouping of 54.68% of the data. That leaves 1/2 of the remaining data, or 22.66% above the target of 20%. Calculating the probability automatically. It is inconvenient to look up the probability values in a table when you are working with a spreadsheet or a computer program, yet the probabilities are easier to understand than the standard deviation values. You can calculate the area under the curve that corresponds to a particular z value, the standard deviation, using the following approximation. Let z prime equals to the absolute values of z, the absolute value of z, then r is equals to 1 plus z prime times ci plus z prime times c3 plus c1 times z prime times c3 plus z prime times c5 times plus z prime times c6, where c1 is equals to 0.049867347, c2 is equals to 0.0211410061, c3 is equals to 0.032776263, c4 is equals to 0.00003800036, c5 is equals to 0.00004889006, c6 is equals to 0.000005383. Then the probability p that the returns will equal or exceed the expected return is p equals to 0.5 times e to the power of ln of r times minus 16. Using the example where the standard deviation z is equals to 0.75, we perform the calculation. R is equals to 1 plus 0.75 times 0.049867347 plus 0.75 times 0.0211410061 plus 0.75 times 0.0032776232 plus 0.78 times 0.0000380036 plus 0.75 times 0.0000488906 plus 0.75 times 0.00005383, where after calculation we know that R is equals to 1.0507, and substituting this value of R into the equation for P, we get P is equals to 0.5 times e to the log of 1.0507 multiplied by minus 16, which after calculation is equals to 0.226627. Then there is a 22.7% probability that a value will exceed 0.75 standard deviations, that is, fall on one end of the distribution outside the value of 0.75. The chance of a value falling inside the band formed by plus or minus 0.75 standard deviation is 1 minus 2 times 0.2266, which is equals to 0.5468 or 54.68%. That is the same value found in table A1.1, appendix 1. For those using Excel, the answer can be found with the function normDist of parameters p, mean, standard deviation, and cumulative, where p is the current price or value, mean is the mean of the series of p's, STDEV is the standard deviation of the series of p's, and cumulative is true if you want the z value. Then the result of a normDist of 35, 20, 5, true is 0.99865 or a 99.8% probability. And if your cumulative is false, then the result is 0.000866. Standard error throughout the development and testing of a trading system. We want to know if the results we are seeing are as expected. The answer will always depend on the size of the data sample and the amount of variance that is typical of data during this period. One descriptive measure of error, called the standard error SE, uses the variance, which gives the estimation of error based on the distribution of the data using multiple data samples. It is a test that determines how the sample means differ from the actual mean of all the data. It addresses the uniformity of the data. That is, standard error SE is equals to the square root of the value of variance divided by n, where VAR is equals to the variance of the sample means, and n is the number of data points in the sample means. Sample means refers to the data being sampled a number of times, each with n data points, and the means of these samples are used to find the variance. In most cases, we would use a single data series and calculate the variance as shown earlier in this chapter. T statistic and the degrees of freedom. When fewer prices or trades are used in a distribution, we can expect the shape of the curve to be more variable. For example, it may be spread out so that the peak of the distribution will be lower and the tails will be higher. A way of measuring how close the sample distribution of a smaller set is to the normal distribution of a large sample of data is to use the t-statistic, also called the student's t-test, developed by W.S. Gaussian. The t-test is calculated according to its degrees of freedom, df, which is n-1, where n is the sample size, the number of prices used in the distribution. T is equals to average of price changes divided by the standard deviation of price changes, then times the square root of n. The more data in the sample, the more reliable the results. We can get a broad view of the shape of the distribution by looking at a few values of t in table 2.2, which gives the values of t corresponding to the upper tail areas of 0.10, 0.05, 0.025, 0.01, and 0.005. The table shows that as the sample size n increases, the values of t approach those of the standard normal values of the tail areas. The values of t that are needed to be significant can be found in Appendix 1, Table A1.2, t distribution. The column headed 0.10 gives the 90% confidence level, 0.05 is 95%, and 0.005 is 99.5%. For example, if we had 20 prices in our sample and wanted the probability of the upper tail to be 0.025, then the value of t would need to be 2.086. For smaller samples, the value of t would be larger in order to have the same confidence. When testing a trading system, degrees of freedom can be the number of trades produced by the strategy. When you have few trades, the results may not represent what you will get using a longer trading history. When testing a strategy, you will find a similar relationship between the number of trades and the number of parameters or variables used in the strategy. The more variables used, the more trades are needed to create expectations with an acceptable confidence level. Two-sample t-test.
Two-sample t-test. You may want to compare two periods of data to decide whether the price patterns have changed significantly. Some analysts use this to eliminate inconsistent data, but the characteristics of price and economic data change as part of the evolving process, and the systematic trading should be able to adapt to these changes. This test is best applied to trading results in order to decide if a strategy is performing consistently. This is done with a two-sample t-test. That is, t equals to p1 bar minus p2 bar, then divided by the square root of var1 squared divided by n1 plus var2 squared divided by n2, where p1 bar and p2 bar is the averages of the prices for periods 1 and 2. VR1 and VR2 is the variances of the prices for periods 1 and 2. N1 and N2 is the number of prices in periods 1 and 2. And the two periods being compared are mutually exclusive. The degrees of freedom df needed to find the confidence levels in table A1.2 can be calculated using Satterthwaite approximation, where S is the standard deviation of the data values. df is equals to s1 squared divided by n1 plus s2 squared divided by n2, then divided by the sum of two values. The first term is s1 squared divided by n1, then 2 to the square, then divided by n1 minus n2 plus s2 squared divided by n2, 2 to the square, then divided by n2 minus n1. When using the t-test to find the consistency of profits and losses generated by a trading system, replace the data items by the net returns of each trade, the number of data items by the number of trades, and calculate all other values using returns rather than prices. Standardizing risk and return. In order to compare one trading method with another, it is necessary to standardize both the tests and the measurements used for evaluation. If one system has total returns of 50% and the other is 250%, we cannot decide which is best unless we know the duration of the test and the volatility of the returns or risk. If the 50% return was over 1 year and the 250% return over 10 years, then the first one is best. Similarly, if the first return had an annualized risk of 10% and the second a risk of 50%, then both would be equivalent. The return relative to the risk is crucial to performance, as will be discussed in Chapter 21, System Testing. For now, it is only important that returns and risk be annualized or standardized to make comparisons valid. Calculating returns. The calculations for both one-period returns and annualized returns will be an essential part of all performance evaluations. In its simplest form, the one-period rate of return R, or the holding period rate of return, is often given as return is equals to ending value minus starting value divided by the starting value, which is equals to ending value divided by starting value minus 1. Then minus 1. For the stock market, which has continuous prices, this can be written as R1 equals to P1 minus P0 divided by P0, which is equals to P1 divided by P0, then minus 1, where P0 is the initial price and P1 is the price after 1 period has elapsed. The securities industry often prefers a different calculation. Rn is equals to ln of Pt divided by Pt minus 1. Both methods have advantages and disadvantages. Neither one is the correct calculation. Note that in some software, the function log is actually the natural log, and log 10 is the log base 10. It is best to always check the definitions. In order to distinguish the two calculations, the first method will be called the standard method, and the second the long method. In the following spreadsheet example, shown in Table 2.3 over 22 days, the standard returns are in column D and the long returns in column E. The differences seem small, but the averages are 0.00350 and 0.00339. The standard returns are better by 3.3% over only one trading month. At this rate, the standard method would have yielded returns that were nearly 40% higher after 1 year. The net asset value NAV used extensively throughout this book compounds the periodic returns and most often has a starting value NAV 0 equals to 100. That is, NAVT is equals to NAVT minus 1 times 1 plus RT. Annualizing returns. In most cases, it is best to standardize the returns by annualizing. This is particularly helpful when comparing two sets of test results where each covers a different time period. When annualizing, it is important to know that government instruments use a 360-day rate based on 90-day quarters. A 365-day rate is common for most other data that can change daily. Trading returns are best with 252 days, which is the typical number of days in a trading year for the United States, 262 days for Europe. The following formulas use 252 days, which will be the standard throughout this book except for certain interest rate calculation. However, 365 or 360 may be substituted, or even 260 for trading days in other parts of the world. The annualized rate of return, AROR, annualized rate of return, on a sample interest basis for an investment over n days is AROR of simple is equals to EN divided by E0 multiplied by 252 then divided by n, where E0 is the starting equity or account balance
En is the equity at the end of the nth period, and the 200 over n, 252 over n, are the years expressed as a decimal. When the one-period returns are calculated using the standard methods, then the annualized the compounded rate of return is AROR compound equals minus En divided by AROR compound is equals to En divided by E0, then to the exponent of 252 divided by n, and after that minus 1. Note that AROR capital refers to the annualized rate of return, while little r is the daily or one-period return. Also, the form of the results is different for the two calculations. An increase of 25% for the simple return will show as 0.25, while the same increase using the compound returns will be 1.25. When the one-period returns using the long method, then the annualized rate of return is the sum of the returns divided by the number of years, AROR long method, which is equals to the summations of Ri, summing with index I starting from 1 to n, then divided by n. An example of this can be found in a column F, the row labeled AROR in the previous spreadsheet. Note that the annualized returns using the long method are much lower than those using division and compounding. The compounded method will be used throughout this book. Probability of returns. The use of the standard deviation and compounded rate of return are combined to find the probability of a return objective. In the following calculation, the arithmetic mean of a continuous returns is ln of 1 plus Rg, and it is assumed that the returns are normally distributed. That is, z is equals to ln of t divided by b minus ln of 1 plus Rg times n, then divided by the square root of s times n, where z is the standardized variable, can be found in the appendix A1, and t is the target value or rate of return objective, b is the beginning investment value, and Rg is the geometric average of periodic returns. N is the number of periods, and S is the standard deviation of the logarithms of the quantities 1 plus the periodic returns. Risk and volatility. While we would always like to think about returns, it is even more important to be able to assess risk. With that in mind, there are two extreme risks. The first is event risk, which takes the form of an unpredictable price shock. The worst of these is a catastrophic risk, which will cause fatal losses or ruin. The second risk is self-induced by over-leverage, or gearing up your portfolio until a sequence of bad trades causes ruin. The risk of price shocks and leverage will both be discussed in detail later in other chapters. The standard risk measurement is useful for comparing the performance of two systems. It is commonly applied to the returns of a single stock or an entire portfolio compared to a benchmark, such as the returns of the S&P 500 or a bond fund. The most common estimate of risk is the standard deviation. Sigma of returns are shown earlier in this chapter. For most discussions of risk, the standard deviation will also be called volatility. When we refer to the target volatility of a portfolio, we mean the percentage of risk represented by one standard deviation of the returns annualized. For example, in the previous spreadsheet, columns D and E show the daily returns. The standard deviations of those returns are shown in the same columns in the row STDV as 0.01512 and 0.01495. Looking only at column D, one standard deviation of 0.01502
means that there is a 68% chance of a daily profit or a loss less than 1.502%. However, target volatility always refers to an annualized risk, and to change a daily return to an annualized one, we simply multiply by the square root of 252. Then the daily standard deviation of returns of 1.512% becomes an annualized volatility of 23.8%, also shown as at the bottom of the spreadsheet example. Because we only care about the downside risk, there is a 16% chance that we could lose 23.8% in 1 year. The greater the standard deviation of returns, the greater the risk. Beta. Beta is commonly used in the securities industry to express the relationship of a single market to an index or portfolio. If beta is 0, then there is no relationship. If it is positive, then the single series tends to move with the index both above and below. As a beta gets larger, the volatility of the single market tends to be increasingly greater than the index. Specifically, 0 less than beta less than 1, the volatility of the single market is less than the index. If beta is equals to 1, the volatility of the single market is the same as the index. If beta is greater than 1, the volatility of the single market is greater than the index. A negative beta is similar to a negative correlation, where the moves of the market are generally opposite to the index. Beta is found by calculating the linear regression of the single market with the index. It is the slope of the single market divided by the slope of the index. Alpha, the added value, is the y-intercept of the solution. The values can be found using Excel and are discussed in detail in Chapter 6. A general formula for beta is beta of A is equals to the covariance of returns A, returns B, divided by the variance of returns B, where A is the single market and B is a portfolio or index. Adjusting to the target volatility. If we have a target volatility of 12%, that is, we are willing to accept a 16% chance of losing 12% in 1 year, but the actual returns show an annualized volatility of 23.8% based on an investment of $100,000. Then, to correct to a 12% target, we simply increase the investment by 23.8 divided by 12, or a factor of 1.98 to $198,000 while holding the same position size. This is essentially deleveraging your positions by trading a smaller percentage of your account value. Alternatively, we can reduce the position size by dividing by 1.98 and keeping the investment the same. All results in this book will be shown at the target volatility of 12% unless otherwise stated. This is considered a modest risk level, which can be as high as 18% for some hedge funds. It will allow you to compare various systems and test results and see them at a level of risk that is most likely to represent targeted trading results. Annualizing daily and monthly returns. The previous examples used the daily data and an annualization factor of the square root of 252. For monthly data, which is most common in published performance tables, we would take the monthly returns and multiply by the square root of 12. In general, annualizing can be done by multiplying the data by the square root of the number of data items in a year. Then we use 252 for daily data, 12 for monthly, 4 for quarterly, and so on. Monthly data always appears less volatile. Although monthly performance results are common in financial disclosure documents,
This convention works to the advantage of the person publishing the performance. It is unlikely that the highest or lowest daily net asset value (NAV) will occur on the last day of the month, so the extremes will rarely be seen. And the performance statistics will appear smoother than when using daily returns. Those responsible for due diligence before investing in a new product will often require daily return data in order to avoid overlooking a large drawdown that occurred mid-month. Using the S&P index as an example, the annualized volatility of the daily returns from 1990 through 2010 was 18.6%, but based on monthly returns, it was only 15.3%. The risk based on monthly returns is 17.7% lower, but the annualized rate of return would be the same because it only uses the beginning and ending values. Downside risk. Because the standard deviation is symmetric, a series of jumps in profits will be interpreted as larger risk. Some analysts believe that it is more accurate to measure the risk as limited to only the downside returns or drawdowns. The use of only losses is called lower partial moments, where lower refers to the downside risk, and a partial means where only one side of the return distribution is used. The easiest way to see this is a semivariance, which measures the dispersion that falls below the mean, R bar, or some target value. Semivariance is equal to the summations of R bar minus Ri, then to the square, summing for all index I starting from 1 to n, then divided by n, where each Ri is less than R bar. However, the most common calculation for system performance is to take the daily drawdowns, that is, the net loss on each day that the total equity is below the peak equity. For example, if the system returns had produced an equity of $25,000 on day T, followed by a daily loss of $500 and another loss of $250, then we would have two values as input 500 divided by 25,000 and 750 divided by 25,000, or 0.02 and 0.03. Only those net returns below the most recent peaks are used in the semivariance calculation. Alternatively, you could just take the standard deviation of these daily drawdowns to find the probable size of the drawdowns. One concern about using only the drawdowns to predict other drawdowns is that it limits the number of cases and discards the likelihood that higher than normal profits can be related to higher overall risk. In situations where there are limited amounts of test data, using both the gains and the losses will give more robust results. When there is a large amount of data, the use of drawdowns can be a very good measurement. A full discussion of performance measurements can be found in Chapter 21, System Testing, and also in Chapter 23, under the headings Measuring Return and Risk and the Author Index. The index. Purpose of an average is to transform individuality into classification. In doing that, the data is often smoothed and the useful information is gained. Indexes have attracted enormous popularity in recent years, where there was only the value line and the S&P 500 trading as futures markets in the early 1980s. Now there are stock index futures contracts representing the markets of every industrialized country. The creation of trusts such as SPDRs, called SPDRs, the S&P 500, Diamonds, DIA, the Dow Jones Industrials, and Qs, QQQ, the Nasdaq 100, have given stock traders a familiar vehicle to invest in the broad market rather than pick individual shares. Industrial sectors such as pharmaceuticals, healthcare, and technology first appeared as mutual funds, then as ETFs, and now can also be traded as futures. These index markets all have the additional advantage of not being constrained by having to borrow shares in order to sell short, or by the uptick rule if it is reinstated, requiring all short sales to be initialized on an uptick in price. Index markets allow both individual and institutional participants a number of specialized investment strategies. They can buy or sell the broad market, they can switch from one sector to another, sector rotation, or they can sell an overpriced sector while buying the broad market index statistic arbitrage. Institutions find it very desirable, from the view of both costs and taxes, to temporarily hedge their cash stock portfolio by selling S&P 500 futures rather than liquidating stock positions. They may also hedge using options on the S&P futures or SPYs. An index simplifies the decision-making process for trading. If an index does not exist, one can be constructed to satisfy most purposes. The index holds an important role as a benchmark for performance. Most investors believe that a trading program is only attractive if it has a better return to risk ratio than a portfolio of 60% stocks as represented by the S&P 500 index and 40% bonds, the Lehman Brothers Treasury Index. Beating the index is called creating alpha, proving that you're smarter than the market. Constructing an index. An index is a standardized way of expressing price movement, normally an accumulation of percentage changes. Most indexes have a starting value of 100 on a specific date. The selection of the base year is often convenient, but can be chosen as a period of price stability. The base year for US productivity and for unemployment is 1982, for consumer confidence 1985, and for the composite of leading indicators 1987. The CRB yearbook shows the Producer Price Index PPI from as far back as 1913. For example, the PPI, which is released monthly, had a value of 186.8 in October 2010 and 185.1 in September 2010, a 0.9184% increase in 1 month. An index value less than 100 means that the index has less value than when it started. Each index value is calculated from the previous value as current index value equals to the previous index value times the current price divided by the previous price. And the one-period returns are calculated in the same way as shown previously in this chapter. Calculating the net asset value, indexing returns. The last calculations shown in the spreadsheet, table 2.3, are the net asset value NAV calculated two ways. This is essentially the returns converted to an index showing the compounded rate of return based on daily profit and the losses relative to a starting investment. In the spreadsheet, this is shown in a column F using standard returns and G using using loan returns. The loan function. The process of calculating NAVs can be done with the following steps. 1. Establish the initial investment, in this case $100,000, shown at the top of column C. This can be adjusted later based on the target volatility. 2. Calculate the cumulative account value
by adding the daily profits or losses column B to the previous account value column C. 3. Calculate the daily returns by either A, dividing today's profit or loss by yesterday's account value to get R, or B, taking the natural log of 1 plus R. For if using method A, then each subsequent NAVT is equal to NAVT minus 1 times the value of 1 plus R. And if using method B, then each NAVT is equal to NAVT minus 1 plus ln of 1 plus R. The final values of the NAV are in the last dated rows. The US government requires that NAVs be calculated this way, although it doesn't specify whether returns should be based on the natural log. This process also identical to indexing, which returns any price series into one that reflects a percentage returns. Leveraged long or short index funds. As index markets have become more popular, financial engineering has created a wide range of innovative trading vehicles. Mutual funds, such as RIDEX and ProFunds, cater to market timers, a group of money managers that may trade in and out of the funds each day. These funds track the major index markets closely, but offer unique variations. They are both long and short funds, and each may be leveraged. When you buy a long fund that tracks the S&P 500, called NOVA by RIDEX, you are simply long the equivalent of the S&P 500. However, when you buy a short S&P fund called URSA, you profit when the S&P index price drops. In addition, both the RIDEX and the ProFunds offer leverage of 1.5 or 2 on these funds, so that a gain of 1% in the S&P 500 translates into a gain of 2% in the ProFunds Ultra Bull S&P fund. A drop of 1% in the S&P would generate a profit of 2% in ProFunds Ultra Bear fund. The motivation behind the short funds or inverse funds is to circumvent the US government rule that does not permit short sales in retirement accounts. The calculation for leveraged long funds is very similar to a simple index. However, a short fund where you profit from a decline in prices is compounded to the upside in the same way as a long fund. The following calculation will create a long and short index that closely approximates those used by RIDEX and ProFunds. In addition, it includes the calculation of the daily high and the low index values. If you intend to create a leveraged S&P index, start with the cash S&P price. Use the cash index equivalent for each of the mutual fund indexes that you plan to duplicate. In the following calculations, leverage is the leverage factor of the fund. Initial index values for both long and short funds are XC1 is equals to 100, XH1 is equals to XC1 plus 100 times H1 divided by C1, then minus 1, then times the leverage. XL1 is equals to XC1 plus 100 times L1 divided by C1, then minus 1, then such a value times the leverage. Each subsequent index value for long fund is XCI is equals to XCI minus 1 times CI divided by CI minus 1, then minus 1, then times leverage, then plus 1. XHI is equals to XCI times HI divided by CI minus 1, then minus 1, then times the leverage, then plus 1. XLI is equals to XCI minus 1 times LI divided by CI minus 1, then minus 1, then times leverage, then plus 1. For each subsequent value for the short funds, invert the middle term. XCI is equals to XCI minus 1 times CI minus 1 divided by CI minus 1, then times the leverage, then plus 1. HI is equals to XCI minus 1 times HI minus 1 divided by CI, then minus 1, then times leverage, then plus 1. XLI is equals to XCI minus 1 times Li minus 1 divided by Ci, then minus 1, then times leverage, then plus 1, where XC, XH, and XL is the leveraged index closing high and low price. CH and L is the underlying close, high, and low prices for index values. If there is no leverage, then substitute the value 1 for leverage in the equations. Cross-market and weighted index. It is very convenient to create an index for two markets that cannot normally be compared because they trade in different units. For example, if you wanted to show the spread between gold and IBM, you could index them both beginning at the same date. The new indexes would then be in the same units, percent, and would be easy to compare. Most often, an index combines a number of related markets into a single number. A simple aggregate index is the ratio of unweighted sums of market prices in a specific year to the same markets in the base year. Most of the popular indexes, such as the New York Stock Exchange Composite Index, fall into the class. A weighted aggregate index biases certain markets by weighting them to increase or decrease their effect on the composite value. Index is then calculated as in the simple aggregate index. When combining markets into a single index value, the total of all the weights will equal 1 and all weights are expressed as a percentage. US dollar index. A practical example of a weighted index is the US dollar index, traded as DX on the New York Board of Trade (NYBOT), and USDX on the Intercontinental Exchange (ICE). It is a trade-weighted geometric average of 6 currencies: the euro 57.6%, the Japanese yen 13.6%, the UK pound 11.9%, the Canadian dollar 9.1%, the Swedish krona 4.2%, and the Swiss franc 3.6%. The dollar index serves as a valuable economic indicator, but shows only 13.6 representing Asia. It is not a good substitute for a diversified world market portfolio. The dollar index rises when the US dollar increases in value relative to the other currencies. In the daily calculation of the dollar index, each price change is represented as a percent. If, for example, the euro rises 50 points from 1.25 to 1.255, the change is 1.255 divided by 1.25, which is equals to 0.004. This is multiplied by its weighting factor 0.576 and contributes minus 0.002304 to the index. A rising euro is a falling dollar. Standard measurements of performance. As important as standardizing risk and return is the need to compare the performance of two funds or two trading models in order to decide which is best. That decision is normally made based on a combination of return and risk. The simplest and most practical of these measurements is the information ratio IR. Information ratio is equals to annualized returns divided by annualized risk, where both annualized returns and annualized risk, the same as annualized volatility, have been given in the previous section of this chapter. When you compare performance using any return-risk ratio, you are looking for the optimum point on the efficient frontier. That is, any fund with a higher return but the same risk will be preferable. And any fund with the same return but a lower risk will be preferable. Sharpe ratio, the Sharpe ratio presented by William F. Sharpe is the most popular of all performance measures. It differs from the more generic information ratio in that it isolates excess return by subtracting the risk-free rate of return from the fund performance. That is, Sharpe ratio is equal to annualized returns minus risk-free returns divided by annualized returns. Trainer ratio. The trainer ratio also isolates excess return. However, it replaces the annualized risk of the fund or trading program with the beta of the portfolio. Beta is the volatility risk of a stock relative to a benchmark index, for example, the S&P. The portfolio beta is the sum of the weighted individual stock betas within the portfolio. If the fund has a beta of 1.2, then it has 20% more volatility than the overall market and moves generally in the same direction. See the previous section on beta. The trainer ratio is trainer ratio equals to the annualized returns minus risk-free returns, then divided by program beta. Other performance measurements. There are numerous variations on performance measures of varying degrees of usefulness. Most often the simplest ones are the best. The value of any measurement is to rank one trading system or fund above another in terms of risk and reward. That is to help make the decision that one is better. The developers of each performance measure believe that each of others is flawed, yet the most popular ratio will usually rank the candidate programs in a similar order. The most common performance measure after the information ratio is simply the maximum drawback relative to the investment size. The maximum drawback should always be measured as a percentage from a highest NAV to the lowest subsequent NAV. The maximum drawback is important because in a long performance record, a single large drawdown can be lost in the standard deviation when there are an overwhelming number of normal drawdowns. A statistician might be satisfied saying that there is a very, very small chance of that large drawback occurring again, but an investor might want to know that it did happen and understand why it happened. One measure that accounts for this is the Kelmer ratio. Kelmer ratio is equal to the annualized return divided by the maximum drawdown. Another measure that tries to focus on drawdowns in the Sterling ratio, it uses downside volatility as the trade, which is the lower partial moment of degree 2, but can also be substituted with the standard deviation of those days in which the NAV was lower than the previous HA NAV. See the circum and in the section of a semivariance. So, by definition, the Sortino ratio is equal to annualized return minus risk-free return divided by the downside volatility. These performance measures will be used to cut through the book when comparing different systems. They will be discussed further along with other performance measures in Chapter 21, System Testing. Probability. Calculation must measure the incalculable. Dixon G. Watts. Change is a term that causes great anxiety. However, the effects and likelihood of a change occurs can only be measured, not predicted. The area of study that deals with the uncertainty is a probability. Everyone uses probability in daily thinking and actions. When you tell someone that you will be there in 30 minutes, you are assuming your car will start, you will not have a breakdown, and you will have no unnecessary delays, and you will drive at a predictable speed, and you will have the normal number of green lights. All these circumstances are extremely probabilistic, and yet everyone makes the same assumptions. Actually, the 30-minute arrival is intended only as an estimate of the average time it should take for the trip. If the arrival time were critical, you would extend your estimate to 40 or 45 minutes to account for unexpected events. In statistics, this is called increasing the configuration interval. You wouldn't raise the time to 2 hours because the likelihood of such a delay would be too remote. Probability is the measuring of the uncertainty surrounding an average value. Probabilities are measured in a percent of likelihood. For example, if m numbers from a total of n are expected to fall within a specific range, the probability p of any one number satisfying the criteria is p equals to m divided by n, where 0 is less than p less than 1. When making a trade or forecasting prices, we can only talk in terms of probabilities or ranges. We expected the prices to rise 30 to 40 points, or we have a 65% chance of a $400 profit from a trade. Nothing is certain, but a high probability of success is very attractive. Laws of probability. Two basic principles of probability are easily explained by using examples with playing cards. In a deck of 52 cards, there are 4 suits of 13 cards each. The probability of drawing a specific card on any one turn is 1 over 52. Similarly, the chances of drawing a particular suit or card number are 1 over 4 and 1 over 13 respectively. The probability of any one of these 3 possibilities occurring is the sum of their individual probabilities. This is known as the law of addition. The probability of success in choosing a number, card, suit, or specific card that is either a 10 or a spade or the queen of hearts is p equals to 1 over 13 plus 1 over 4 plus 1 over 52, which is equals to 18 divided by 52, which is equals to 35%. The other basic principle, the laws of multiplication, states that the probability of 2 occurrences happening simultaneously or in succession is equal to the product of their separate probabilities. The likelihood of drawing a 3 and a club from the same deck in 2 consecutive turns, replacing the card after each draw, or of drawing the same cards from 2 decks simultaneously is p equals to 1 over 13 times 1 over 4, which is equals to 1 over 82, which is equals to 2%.
In fact, approximately 2%. Joined and a marginal probability. Price movement is not as clearly defined as a deck of cards. There is often a relationship between successive events. For example, over 2 consecutive ways, prices must have one of the following sequences or joint events: up, up, down, down, up, down, down, up, with the joint probabilities of 0.40, 0.10, 0.35, and 0.15 respectively. In this example, there is the greatest expectation that prices will rise. The marginal probability of a price rise on the first day is shown in Table 2.4, which concludes that there is a 75% chance of higher prices on the first day and a 55% chance of higher prices on the second day. Contingent probability. What is the probability of an outcome conditioned on the result of a prior event? In the example of joint probability, this might be the chance of a price increase on the second day when prices declined on the first day. The notation for this situation, the probability of A conditioned on B, is P of A conditioning on B, which is equals to the probability of A and B divided by P of B, which is the joint probability of A and B divided by the marginal probability of B. Then P of up day 2 conditioned on down day 1 is equals to the joint probability of down up divided by the marginal probability of down day 1, which is equals to 0.15 divided by 0.25, which is equals to 0.6. The probability of either a price increase on day 1 or a price increase on day 2 is P of either, which is equals to P of up day 1 plus P of up day 2 minus P of up day 1 and up day 2, which is equals to 0.75 plus 0.55 minus 0.4, which is equals to 0.9. Markov chains. If we believe that today's price movement is based on, in some part, on what happened yesterday, we have a situation called a conditional probability. This can be expressed as a Markov process or Markov chain. The results or outcomes of a Markov chain express the probability of a state or condition occurring. For example, the possibility of a clear, cloudy, or rainy day tomorrow can be related to today's weather. The different combinations of dependent possibilities are given by a transition matrix. In our weather prediction example, a clear day has a 70% chance of being followed by another clear day, a 25% chance of a cloudy day, and only 5% chance of rain. In Table 2.5, each possibility today is shown on the left, and its probability of changing tomorrow is indicated across the top. Each row totals 100% and accounts for all weather combinations. The relationship between these events can be shown as a continuous network. See Figure 2.11. The Markov process can reduce intricate relationships to a simpler form. First, consider a two-state process. Using the markets as an example, what is the probability of an up or down day following an up day or following a down day? If there is a 70% chance of a higher day following a higher day, which we can say is an uptrend, and a 55% chance of higher day following a lower day, what is the probability of any day within an uptrend being up? Started with either an up or down day, and then calculated the probability of the next day being up or down. This is done easily by simply counting the number of cases given in Table 2.6a, then dividing to get the percentages as shown in Table 2.6b. Because the first day may be designated as up or down, it is an exception to the general rule, and therefore it is given the weight of 50%. The probability of the second day being up or down is the sum of the joint probabilities. P of up 2, which is equals to 0.50 times 0.70 plus 0.50 times 0.55, which is equals to 0.625. The probability of the second day being up is 62.5%. Continuing in the same manner, use the probability of an up day as 0.625, the down as 0.375, and calculate the third day. P up 3 is equals to 0.625 times 0.7 plus 0.375 times 0.55, which is equals to 0.64375. And the fourth day, P of up 4 is equals to 0.64375, which is the number from P of up 3 times 0.7 plus 0.35625, which is 1 minus P up 3 times 0.55, which is equals to 0.64656, which can now be seen to be converging. To generalize the probability of an update, look at what happens on the ith day. That is, P up of I plus 1 is equals to P up I times 0.7 plus 1 minus P up of I times 0.55. Because the probability is converging, the relationship that P of up I plus 1 is equals to P of up I can be substituted and used to solve the equation. That is, P of up I is equals to P of up I times 0.7 plus 0.55 minus P of up I times 0.55. Given the probability of any day being up within an uptrend as P up of I is equals to 0.64705, we can find the chance of an up or down day if the 5-day trend is up simply by substituting the direction of the 5-day trend or n-day trend for the previous day's direction in the example just given. Predicting the weather is a more involved case of multiple situations converging and may be very representative of the way prices reacted to past prices. By approaching the problem in the same manner as the two-stage process, a 1/3 probability is assigned to each situation for the first day. The second day's probability is P of clear 2 is equals to 1/3 times 0.7 plus 1/3 times 0.2 plus 1/3 times 0.2, which is equals to 0.3663. P of cloudy 2 is equals to 1/3 times 0.25 plus 1/3 times 0.60 plus 1/3 times 0.40, which is equals to 0.41625. P of rainy 2 is equals to 1/3 times 0.05 plus 1/3 times 0.2 plus 1/3 times 0.4, which is equals to 0.21645. Then using the second day results, the third day is P of clear 3 is equals to 0.3663 times 0.7 plus 0.41625 times 0.2 plus 0.21645 times 0.2, which is equals to 0.38295. P of cloudy 3 is equals to 0.3663 times 0.25 plus 0.41625 times 0.6 plus 0.21645 times 0.4, which is equals to 0.42791. P of rainy 3 is equals to 0.3663 times 0.05 plus 0.41625 times 0.2 plus 0.21645 times 0.4, which is equals to 0.18815. The general form for solving these three equations is P of clear I plus 1 is equals to P of clear I times 0.7 plus P of cloudy I times 0.2 plus P of rainy I times 0.2. P of cloudy I plus 1 is equals to P of clear I times 0.25 plus P of cloudy I times 0.60 plus P of rainy I times 0.40. P of rainy I plus 1 is equals to P of clear I times 0.05 plus P of cloudy I times 0.2 plus P of rainy I times 0.4, where each I plus 1 element can be set equal to the corresponding ith value. There are then three equations in three unknowns which can be solved directly or by matrix multiplication as shown in Appendix 2, solution to weather probabilities expressed as a Markov chain. Otherwise, it will be necessary to use the additional relationship. That is, P of clear I plus P of cloudy I plus P of rainy I is equals to 1. The results are P of clear equals to 0.4, and P of cloudy equals to 0.425, and P of rainy is equals to 0.175. Bayes' theorem, although historic generalization exists concerning the outcome of an event, a specific current market situation may alter the probabilities. Bayes' theorem combines the original probability estimates with the added event probability, the reliability of the new information to get a posterior or revised probability. That is, P of original and added event divided by P of added event. Assume that the price changes P of up and P of down are both original probabilities and an added event probability, such as an unemployment report, trade balance, crop report, inventory stocks, or Federal Reserve interest rate announcement is expected to have an overriding effect on tomorrow's movement. Then the new probability P of up conditioned on added event is P of up and added event divided by P of up and added event plus P of down and added event. So where up and down refer to the original historic probabilities, and P of A and B is just a joint probability. Bayes' theorem finds the conditional probability even if the joint and marginal probabilities are not known. The new probability P of up conditioned on added event is P of up times P of added event conditioned on up divided by P of up times P of added event conditional on up plus P of down times P of added event conditioned on down, where P of added event conditioned on up is equal to the probability of the new event being a correct predictor of an upwards move. P of added event conditioned on down is equal to the probability of prices going down when the added news indicates up. For example, if a 0.25% decline in interest rates has a 90% chance of causing stock prices to move higher, then P of added event conditioned on up is equal to 0.9, and P of added event conditioned on down is equal to 0.10. Supply and demand. Price is the balancing point of supply and demand. In order to estimate the future price of any product or explain its historic patterns, it will be necessary to relate the factors of supply and demand and then adjust for inflation, technological improvement, and other indicators common to econometric analysis. The following sections briefly describe these factors. Demand. The demand for a product declines as price increases. The rate of decline is always dependent on the need for the product and its available substitutes at different price levels. In figure 2.128, D represents a normal demand for a product over some fixed period. As prices rise, demand declines fairly rapidly. D prime represents increased demand resulting in higher prices at all levels. Figure 2.12b represents the actual demand relationship for potatoes from 1929 to 1939. Although this example is the same as the theoretical relationship in figure 2.128, in most cases the demand relationship is not a straight line. Production costs and minimal demand prevent the curve from going to zero. Instead, it approaches a minimum price level. This can be seen previously in the frequency distribution for wheat, figure 2.3, where the left side of the distribution falls, lower price of sharply. On the higher end of the scale, there is a lag in the response to increase the prices and a consumer reluctance to reduce purchasing even at higher prices, called inelastic demand. Coffee is well known for having inelastic demand. Most coffee drinkers will pay the market price rather than consume less. Figure 2.12c shows a more representative demand curve, including extremes where 100% represents the cost of a production for a producer. The demand curve therefore shows the rate at which a change in a quantity demanded brings about a change in price. Note that although a producer may lose money below 100, lack of demand and the need for income can force sales at a loss. Elasticity of demand. Elasticity is the key factor in expressing the relationship between price and demand and defines the shape of the curve. It is the relative change in the demand as price increases. That is, ED is equals to relative change percentage in demand divided by relative change percentage in price. A market that always consumes the same amount of a product, regardless of price, is called inelastic. As price rises, the demand remains the same, and ED is negatively very small. An elastic market is just the opposite. As demand increases, price remains the same, and ED is negatively very large. Figure 2.13 shows the demand curve for various levels of demand elasticity. If supply increases for a product that has existed in short supply for many years, consumer purchasing habits will require time to adjust. The demand elasticity will gradually shift from relatively inelastic, figure 2.13b, to relatively elastic, figure 2.13a. Supply. The supply side of the economic equation is the normal counterpart of demand. Figure 2.14a shows that as price increases, the supplier will respond by offering greater amounts of the product. Figure 2.14b demonstrates the supply at price extremes. At low levels below production costs, there is a nominal supply by those producers who must maintain operations due to high fixed costs and difficulty restarting after a shutdown. As in mining, at high price levels, supply is erratic. There may be insufficient supply in the short term, followed by the appearance of new supplies or substitutes, as in the case of a location shortage. When there is a shortage of orange juice, South America countries are willing to fill the demand. When there is an oil disruption, other OPEC nations will increase production. In most cases, however, it is a reduced demand that brings price down. Elasticity of a supply. The elasticity of supply ES is the relationship between the change in supply and the change in price. ES is equals to relative change percentage in supply divided by relative change percentage in price. The elasticity of supply, the counterpart of demand elasticity, is a positive number because price and quantity move in the same direction at the same time. Equilibrium, the demand for a product that the supply of that product cross at a point of equilibrium. The current price of any product or any security represents the point of equilibrium for that product at that moment in time. This is the basis for the technical assessment that the price at any moment in time represents the netting of all fundamental information. Figure 2.515 shows a constant demand line D and a shifting supply increasing to the right from S to S prime. The demand line D and the original supply line S meet at the equilibrium price P. After the increased supply, the supply line shifts to S prime. The point of equilibrium P prime represents a new price, the consequence of a larger supply with unchanged demand. Because supply and demand each have varying elasticities and are best represented by curve. The point of equilibrium can shift in any direction in a market with changing factors. Equilibrium will be an important concept in developing trading strategies. Although the supply and demand balance may not be calculated in practical terms, equilibrium is a balance between buyers and sellers, a price level at which everyone is willing to trade, although not always happy to do so at that time. Equilibrium is associated with a lower volatility and often lower volume because the urgency to buy or sell has been removed. Imbalance in the supply-demand-price relationship cause volatility. Readers interested in a practical representation of equilibrium or price-value relationships should study price distribution systems in Steldmayer's Market Profile, Chapter 18. Cobweb charts, the point at which the supply and demand lines cross, is easily translated into a place at which the supply on the price chart where the direction is sideways. The amount of price volatility during the sideways period called noise depends upon the price level, market participation, and various undertones of instability caused by other factors. The price level is discussed about how price patterns reflect the shift in sentiment. Varies between the supply and demand lines caused by other factors. Clear representation of this action about how price patterns Cobweb reflects the shift. Figure 2.16 shows a static and symmetric supply-demand chart there is a with the dotted lines representing the Cobweb. A shift chart in the perceived importance of supply and demand factors symmetric and cause prices to reflect the dotted lines shown by the direction of the arrows on the Cobweb in the producing the sideways market represented by figure 2.16b prices if the Cobweb were closer to the intersection of the supply and demand lines. The volatility of the sideways price pattern would be lower. If the Cobweb were further away from the intersection, the sideways would be more volatile. Figure 2.16b Most supply and demand relationships are not static and can be represented by lines that cross at oblique angles. In Figure 2.17a, the Cobweb is shown to begin near the intersection and move outwards, each shift forming a different length strand of the web moving away from equilibrium. Figure 2.17b shows that the corresponding price pattern is one that shifts from equilibrium to increasing volatility. A reversal in the arrows on the Cobweb would show decreasing volatility, moving toward equilibrium. Building a model. A model can be created to explain or forecast price changes. Most models explain rather than forecast. Explanatory models analyze sets of data at concurrent times. That is, they look for relationships between multiple factors and their effect on price at the same moment in time. They can also look for causal or lagged relationships where prices respond to other factors after one or more days. It is possible to use the explanatory model to determine the normal price at a particular moment. Although not considered forecasting, Any variation in the actual market price from the normal or expected price could represent a trading opportunity. Methods of selecting the best forecasting model can affect its credibility. An analytic approach selects the factors and specifies the relationships in advance. Tests are then performed on the data to verify the premise. Many models, though, are refined by fitting the data using regression analysis or some mass testing process, which applies a broad selection of variables and weighting factors to find the best fit. These models, created with a perfect hindsight, are far less likely to be successful at forecasting future price levels. Even an analytic approach that is subsequently fine-tuned could be in danger of losing its forecasting ability. The factors that comprise a model can be both numerous and difficult to obtain. Figure 2.18 shows the interrelationship between factors in the cocoa industry. Although this chart is comprehensive in its intra-market relationships, it does not emphasize the global influences that have become a major part of price movement since the mid-1970s. The change in value of the US dollar and the volatility of interest rates have had far greater influence on price than some of the normal fundamental factors for many commodities. Companies with high debt may find the price fluctuations in their stock are larger due to interest rate changes than increases or decreases in the revenues. Models that explain price movements must be constructed from the primary factors of supply and demand. A simple example for estimating the price of 4 potatoes is P divided by PPI is equals to A plus BS plus CD, where P is the average price of 4 potatoes received by farmers. PPI is the producer price index. S is the apparent domestic free supply. Production less exports apparent domestic free supply. T is the estimated deliverable supply. And diversions. And A, B, and D are constants determined by regression analysis. This model implies that consumption must be constant, determined by regression elastic demand. Demand factors are only implicitly included in the estimated deliverable supply. Demand factors are only implicitly included in the estimated deliverable supply. The use of the PPI and the diversion represent the results in relative terms based on whether the index was used as an inflator or deflator of price. The general model presented by Weimar may be written as 3 behavior-based equations and 1 identity. Consumption. Okay, the formula of consumption. CT is equals to FC of PT and PT to the L plus ECT. Production is HT equals to FH of PT to the L plus EHT. Inventory IT is equals to IT minus 1 plus HT minus CT. Supply of storage is PT prime minus PT is equals to FP of IT plus EP, where C is the consumption and P is the price. P to the L is the lagged price, H is the production harvest, and I is the inventory. P prime is the expected price at some point in the future, and E is the corresponding error factor. The first 2 equations show that both demand and supply depend on current and or lagged prices. The traditional macroeconomic theory, production and consumption are therefore dependent on past prices. The third equation, inventory level, is simply the total of previous inventories, plus new production less current consumption. The last equation, supply of storage, demonstrates that people are willing to carry larger inventories if they expect prices to increase substantially. The inventory function itself, the third equation, is composed of two separate relationships: manufacturers' inventories and speculators' inventories. Each react differently to expected price change. Changing factors. Although the PPI was always considered the component of inflation and used in forecasting prices, the value of the US dollar has not been an input. Currency values have always fluctuated but have taken on more significance following the dropping of the gold standard by most countries. The value of a currency is based on the health of the economy as measured by production output and inflation, among other factors. Wheat is a good example to show the impact of these changes. As an export market for the United States, the price of wheat reflects the world value, that is, what other countries are willing to pay. Wheat is fungible. In other words, a country in need will buy from any source with the lowest price, and that keeps all prices competitive. Rather than the complex analysis of factors shown in the previous section on cocoa, we will only look at the impact of inflation and currency changes on the price of wheat. Figure 2.19 shows the monthly price of cash wheat along with the PPI and the US dollar index DX. The dollar index shows the relative value of the US dollar. Therefore, a decline in DX indicates a weaker US dollar. Both
Figure
the PPI and DX have been indexed to begin 1985 with the monthly price of cash wheat. In Figure 2.19, the PPI nearly doubles from 1.0 to 1.8, while the US dollar halves to 0.51. At the same time, wheat prices rise 69% from 100 to 169. The cash price from $3.56 to $7.13. If we are only concerned with the big picture, the macro factors, rather than the seasonality of price, then the rise in wheat prices over a 25-year interval can be completely explained by either the PPI or the DX. In fact, they are clearly related because inflation PPI has a negative effect on the currency value. By dividing the indexed price of wheat by the PPI or multiplying wheat by the DX value, Figure 2.20 shows that the long-term price of wheat is unchanged. By observation, we can conclude that the rise in wheat prices is attributed to inflation, the decline in the value of the US dollar, or both. If we then want to look at the effect of seasonality or supply and demand factors that cause wheat prices to lose 75% of its value or gain 100%, we need to remove the effect of inflation first. For trading, this means selling DX in the same dollar value as buying wheat, so that if the price of wheat rises due to the US dollar falling, the change in value of the hedge position is close to zero. In the case of wheat, it is clear that the price is affected by inflation. It may be that the success of most wheat trading strategies depends on the trend of inflation rather than the underlying wheat factors. However, if the intent is to profit from seasonal moves, then a rally in May when a good crop is being harvested may be obscured by a rise in the US dollar. Without hedging the potential effect of the dollar, you leave the results of the strategy to chance. This will be discussed with examples in Chapter 10, Seasonality and the Calendar Patterns. Economic reports. Economic reports are released nearly every day. Based on the economic condition of the nation, investor focus shifts from one report to another. Since 2008, the focus has been on the employment reports, the ultimate solution to recover GDP, a measure of the recovery, and of less importance, housing, consumer confidence, and various manufacturing data. The leading economic index, LEI, released by the Conference Board each month, tries to anticipate the direction of the economy about 6 months ahead based on the following factors: average weekly hours manufacturing, average weekly initial claims for unemployment insurance, manufacturers' new orders, consumer goods and materials, index of supplier deliveries, vendor performance, manufacturers' new orders, non-defense capital goods, building permits, new private housing units, stock prices 500 common stocks, money supply M2, interest rate spread 10-year treasury bonds less federal funds, index of consumer expectations. Most of these seem reasonable, but the weighting of them is not clear. It has been said that the direction of the stock market plays a relatively large part in the index. Can these and other indicators be used for trading? Are they timely, or are the expectations of their impact in the market even before the reports are released? With many reports, the market anticipates the numbers. If unemployment was expected to increase, then the stock market tends to sell off ahead of the report, or if economists anticipate the Fed lowering rates, then the yield curve will adjust to that expectation ahead of the announcement. Therefore, it is the difference between the expectation and the actual report that moves the market, and only secondarily is it the actual numbers released. For example, if the GDP was expected to rise from 3.5% to 4%, and the actual number came in at 3.6%, the market would sell off. But then it would rally again because 3.6% is still a good number indicating growth. While large unexpected changes move the market, the cumulative effect of small changes could also be significant. Rodriel has quantified the significance of some of these indicators, concentrating on predicting the direction of yields, which is key to much of the financial market price moves. Interest rates ratio is equal to 1 minus rate of inflation divided by yield. So inflation yield oscillator is IYU is equals to R minus R bar, where yield is the 3-month treasury bill and R bar is the 20-day average of the ratio R. If R is less than 0.2 or IYO is less than 0 and yield T is greater than yield T minus 3 months, then rates will rise. If R is greater than 0.3 or IYO is greater than 0.5 and yield T is less than yield T minus 3 months, then rates will fall. Money supply using monthly data for M2 and the 3-month treasury bill yields, where M is the current month. If M2M minus M2M minus 1 is greater than M2M minus M2M minus 6, and yield T is greater than yield T minus 11 months, then rates will rise. If M2M minus M2M minus 1 less than M2M minus M2M minus 6 and yield T less than yield T minus 11 months, then rates will fall. Consumer sentiment using the University of Michigan's Consumer Sentiment Survey CS, and where M is the month it is released. If CSM is greater than CSM minus 12, and CSM is greater than CSM minus 11, and yield T is greater than yield T minus 4 months, then rates will rise. If CSM is less than CSM minus 12, and CSM is less than CSM minus 11, and yield T is less than yield T minus 4 months, then rates will fall. Unemployment claims. Using monthly unemployment claims UC released on the first Friday of each month. If UCM is less than UCM minus 11 and UCM is greater than UCM minus 14, then rates will rise. If UCM is greater than UCM minus 11 and UCM is less than UCM minus 14, then rates will fall. The big picture of price direction is very important, and an accurate forecast can greatly improve results. Using fundamental data in a systematic way is perfectly consistent with other algorithmic approaches.